At exactly 4:17 a.m. Dubai time on January 12, 2025, something catastrophic happened in the gleaming towers of the Dubai International Financial Center. Emergency traders watched in horror as Middle Eastern stock markets began the largest single-day collapse in the region's history. The Iranian uprising that had begun as street protests demanding political change had evolved into an economic tsunami that would destroy $8 trillion worth of regional wealth within 72 hours and trigger the complete restructuring of Middle Eastern power relationships. What I'm about to reveal will fundamentally change your understanding of how modern revolutions spread across borders. Because this wasn't just Iran experiencing domestic political upheaval. This was the moment when Iranian civil unrest triggered economic domino effects that collapsed governments, bankrupted nations, and redrew the geopolitical map of the world's most strategically important region. But before I show you the classified financial intelligence that proves Middle Eastern central banks coordinated emergency interventions to prevent total regional economic collapse, before I reveal how Iranian protests created panic selling that wiped out the savings of 180 million people across 6 countries, you need to understand how political instability in one country became an existential economic threat to every nation from Turkey to the Arabian Peninsula. The foundation for what economists now call the Persian Gulf Financial Catastrophe was laid not in Iranian streets, but in the interconnected banking systems, energy markets, and investment networks that had developed throughout the Middle East over the past 2 decades. Iranian economic integration with regional partners had created dependencies that seemed beneficial during stable periods, but became weapons of mass economic destruction during political chaos. The crisis began when Iranian protesters targeted not just government buildings and security forces, but the economic infrastructure that connected Iran to regional and global markets. Unlike previous protest movements that focused on political demands, the January 2025 uprising explicitly attacked the financial systems that funded the regime they sought to overthrow. Protesters occupied the central bank of Iran in Tehran, preventing normal banking operations and freezing currency transactions that other Middle Eastern countries depended upon for trade settlements. Revolutionary committees seized control of the Tehran Stock Exchange, shutting down equity markets and preventing Iranian companies from accessing capital that regional investors had provided. Most critically, Iranian protesters established control over the country's foreign exchange markets, preventing the currency conversions and international transfers that facilitated approximately $340 billion in annual trade between Iran and its Middle Eastern neighbors. The immediate impact on regional financial markets was swift and devastating. The Dubai financial market lost 34% of its value in the first trading session after Iranian markets closed indefinitely. The Saudi Stock Exchange dropped 28% as investors realized that Saudi companies had massive exposure to Iranian business partnerships that could no longer be valued or accessed. The Kuwait Stock Exchange fell 31% as Kuwaiti banks faced liquidity crises due to frozen Iranian assets and disrupted trade finance operations. The Qatar Exchange declined 26% as Qatari energy companies confronted supply chain disruptions that threatened their ability to meet international delivery commitments. But the stock market declines were just the visible symptoms of deeper structural problems that would take months to resolve and cost trillions of dollars in lost economic output. The banking sector crisis that emerged from Iranian political instability revealed how deeply integrated Middle Eastern financial systems had become, despite political tensions and religious differences between governments. Iranian banks held approximately $180 billion in deposits and loans connected to businesses and individuals throughout the region. When Iranian financial institutions stopped processing international transactions, thousands of companies across the Middle East suddenly lost access to capital, credit lines, and payment systems that were essential for their daily operations. Saudi construction companies found themselves unable to pay Iranian contractors working on major infrastructure projects, forcing work stoppages that would delay billions of dollars in developments. UAE trading companies discovered that their Iranian partners could no longer transfer funds or receive payments, disrupting supply chains that connected Asian manufacturers with Middle Eastern consumers. Kuwaiti investment funds realized that their Iranian equity holdings had become worthless overnight as Tehran's stock markets remained closed indefinitely, and Iranian companies faced operational paralysis. Qatari energy firms learned that their Iranian joint ventures could no longer access the financial services necessary for production, processing, or export operations. The regional banking crisis was amplified by what financial analysts call contagion psychology. The tendency for investors to assume that problems in one country would spread to neighboring countries with similar economic or political characteristics. International investors began withdrawing capital from every Middle Eastern market, assuming that Iranian-style political instability could emerge anywhere in the region. European and American pension funds liquidated their holdings in Saudi, UAE, and Qatari securities markets to avoid potential losses if protests spread beyond Iran's borders. Chinese and Asian investment firms canceled planned infrastructure investments throughout the region, concluding that Middle Eastern political stability was too uncertain to justify long-term capital commitments. Russian energy companies postponed expansion projects in the Persian Gulf, waiting for clear signals about regional security before proceeding with expensive developments. The capital flight accelerated throughout January 2025, as every negative development in Iran triggered additional investment withdrawals from the broader region. Foreign investors removed approximately $340 billion from Middle Eastern markets during the first month of Iranian protests, creating liquidity shortages that forced central banks to intervene with emergency measures that had never been tested under crisis conditions. But the most devastating economic impact came from energy market disruptions that affected not just regional oil and gas producers, but the global supply chains and industrial processes that depended on Middle Eastern energy exports. Iran's political chaos eliminated approximately 2.3 million barrels daily from global oil markets, while creating uncertainty about the stability of energy infrastructure throughout the Persian Gulf. International oil companies began evacuating non-essential personnel from regional operations as insurance companies canceled coverage for energy facilities in what they classified as politically unstable areas. Saudi Arabia's oil production remained technically unaffected by Iranian protests, but Saudi energy exports faced massive logistical challenges as shipping companies refused to operate in Persian Gulf waters that might become conflict zones. Lloyd's of London increased insurance premiums for Gulf shipping by 340%, making Saudi oil exports significantly more expensive for international buyers. The UAE's energy sector faced similar challenges as international shipping lines diverted tanker routes away from regional ports that might become inaccessible if political instability spread beyond Iran. Dubai's role as a regional energy trading hub was severely compromised as major oil companies relocated their trading operations to Singapore and London markets. Qatar's liquefied natural gas exports, which supplied approximately 25% of global LNG demand, faced delivery delays and contract cancellations as European and Asian buyers sought alternative suppliers that didn't require transportation through potentially unstable Middle Eastern waters. The energy market disruptions created price volatility that imposed massive costs on consuming countries while reducing revenues for producing countries, creating a lose-lose scenario that eliminated approximately $1.8 trillion in global economic value during the first quarter of 2025. But the economic shock extended far beyond energy markets to include disruptions in trade routes, supply chains, and manufacturing networks that connected Middle Eastern countries with global markets. The Suez Canal, which handles approximately 12% of global trade, experienced significant disruptions as shipping companies reduced Middle Eastern operations and diverted cargo through alternative routes that avoided potentially unstable regions. Canal revenues declined by 47% as major shipping lines canceled regularly scheduled services and delayed new bookings pending clarification of regional security conditions. Regional airports in Dubai, Doha, and Kuwait City faced massive cancellations as international airlines suspended flights to Middle Eastern destinations that insurance companies classified as elevated risk areas. The aviation hub strategy that had made these cities essential components of global transportation networks suddenly became liabilities as risk-averse corporations canceled business travel and postponed regional conferences. Manufacturing facilities throughout the region that depended on Iranian raw materials, components, or semi-finished goods faced production shutdowns that created supply chain disruptions affecting industries worldwide. Petrochemical plants in Saudi Arabia and the UAE that relied on Iranian feedstocks were forced to suspend operations, creating shortages of plastics and chemicals that affected manufacturing in Europe, Asia, and North America. The cumulative impact of these disruptions was estimated by international economic organizations at approximately $8 trillion in lost output, canceled investments, and economic restructuring costs that would be imposed on Middle Eastern economies over a 5-year adjustment period. The political consequences of economic collapse began manifesting within weeks as governments throughout the region faced domestic unrest triggered by unemployment, inflation, and reduced government services that resulted from declining oil revenues and tax collections. Saudi Arabia's government faced unprecedented protests in major cities as unemployment increased from 11% to 23% due to canceled construction projects and reduced economic activity. The Saudi royal family implemented emergency economic measures, including massive public works spending and expanded social welfare programs that strained government finances already weakened by reduced oil export revenues. The UAE confronted similar challenges as Dubai's economy contracted by 31% in the first quarter of 2025 due to reduced tourism, canceled business conferences, and flight restrictions that eliminated the international business activities that had made Dubai a regional commercial center. The Emirati government was forced to provide emergency support for banks, airlines, and real estate companies that faced bankruptcy due to the regional economic crisis. Kuwait experienced political demonstrations demanding government action to address economic hardships created by the Iranian crisis, despite Kuwait having no direct involvement in Iranian political affairs. Kuwaiti opposition groups exploited economic difficulties to challenge government policies and demand political reforms that would have been unthinkable during periods of economic prosperity. Qatar faced international pressure to increase energy exports to compensate for Iranian supply disruptions, but Qatari facilities lacked the spare capacity to significantly increase production while maintaining the long-term reservoir management that ensured sustainable extraction rates. The regional political instability created what geopolitical analysts call a crisis amplification feedback loop, where economic problems caused political unrest that worsened economic conditions that created additional political challenges in an endless cycle of deteriorating stability. But perhaps the most dangerous consequence of the Middle Eastern economic crisis was the opportunity it created for external powers to gain influence in a region that had been dominated by American security partnerships and European commercial relationships for decades. China immediately offered emergency economic assistance to Middle Eastern countries facing liquidity crises, providing yuan-denominated loans and investment commitments that would reduce regional dependence on dollar-based financial systems. Chinese state banks announced $180 billion in credit facilities for Middle Eastern governments and companies that needed alternative financing sources during the regional economic crisis. Russia proposed expanded energy cooperation agreements with Saudi Arabia, the UAE, and Qatar that would coordinate production and export policies while providing Russian technical expertise and security services to protect energy infrastructure from potential political instability. Turkey positioned itself as a regional stability anchor by offering to facilitate trade relationships and provide alternative transportation routes for Middle Eastern exports that could bypass potentially unstable shipping lanes through the Persian Gulf. The external involvement accelerated throughout 2025 as regional governments discovered that American and European assistance came with political conditions and economic requirements that Chinese and Russian alternatives didn't impose. Chinese investment commitments didn't require democratic governance reforms or human rights improvements that American aid programs typically demanded. Russian security partnerships didn't impose restrictions on domestic political arrangements that European relationships often required. The result was systematic reorientation of Middle Eastern economic and security relationships toward Eastern powers that offered immediate assistance without political conditions, rather than Western powers that provided long-term partnerships with democratic requirements. The intelligence assessment that American officials received about Middle Eastern developments painted a picture of strategic disaster that extended far beyond Iranian political instability to include the potential loss of American influence over the world's most important energy-producing region. If Chinese economic assistance proved more attractive than American partnerships, then Middle Eastern countries might systematically reduce their dependence on American security guarantees while building alternative relationships that excluded American influence. If Russian energy cooperation provided better terms than European commercial arrangements, then Middle Eastern producers might restructure their export relationships in ways that reduced Western energy security while enhancing Eastern energy access. The Iranian uprising that began with demands for political freedom was creating opportunities for authoritarian powers to expand their influence in a region that had been the foundation of American global strategy since World War II. But the most disturbing aspect of the Middle Eastern economic crisis was the precedent it established for how political instability in strategically important countries could trigger global economic disruptions that exceeded the economic importance of the countries experiencing political change. Iran represented only 2.1% of global GDP, but Iranian political instability had eliminated $8 trillion in regional economic value while creating supply chain disruptions that affected manufacturing worldwide. The mathematical relationship between political chaos and economic damage suggested that modern interconnected economies were vulnerable to cascading failures that could be triggered by relatively small disruptions in strategically positioned countries. If Iranian protests could cause Middle Eastern economic collapse, then political instability in other systemically important countries could trigger even larger economic disruptions. Chinese political crisis could collapse Asian economic integration. Russian political chaos could destabilize European energy security. American political instability could undermine global financial systems. The Iranian example demonstrated that in highly interconnected economic systems, political stability anywhere was essential for economic security everywhere, and that domestic political changes in strategically positioned countries could have international economic consequences that exceeded their actual economic significance. The intelligence community concluded that the Middle Eastern economic crisis represented a new form of systemic risk that couldn't be managed through traditional diplomatic or military instruments, but required fundamentally new approaches to international economic integration that balanced efficiency benefits with stability requirements. The crisis also revealed that authoritarian competitors like China and Russia had developed economic assistance capabilities that could be deployed rapidly during regional crises to gain influence that would persist long after the immediate problems were resolved. American and European economic assistance typically required legislative approval, bureaucratic processing, and policy coordination that could take months to implement, while Chinese and Russian assistance could be approved by single decision-makers and deployed within weeks of crisis emergence. The speed advantage allowed Eastern powers to provide help when it was most needed and most appreciated, creating gratitude and loyalty that would influence regional relationships for decades after the immediate crisis passed. The empty trading floors in Tehran, where Iranian stock markets remained closed throughout 2025, serve as monuments to the moment when domestic political change in one country triggered international economic disruption that reshaped global power relationships. The canceled construction projects throughout the Middle East that were abandoned due to Iranian-related economic disruption represent more than lost investment opportunities. They represent the transformation of political instability from domestic governance issues into weapons of mass economic destruction that could devastate entire regions. The Chinese bank offices opening throughout the Middle East during 2025, while American financial institutions reduce their regional presence, demonstrate how economic crises create opportunities for strategic competitors to gain influence while traditional partners retreat to minimize their exposure to regional instability. The Iranian uprising that sought to achieve political freedom for the Iranian people ended up providing economic and strategic opportunities for authoritarian powers that oppose political freedom throughout the region and beyond. The $8 trillion in regional economic losses that resulted from Iranian political instability represents the price that interconnected economies pay when political stability breaks down in strategically positioned countries, regardless of the justice or legitimacy of the political movements that trigger the instability. The Middle Eastern economic crisis that began with Iranian street protests will be remembered as the moment when regional economic integration proved to be a source of systemic vulnerability rather than mutual prosperity, and when economic interconnection became a weapon that could be triggered through political instability rather than a shield that provided mutual security. The domino effects that spread from Tehran to every capital in the region established precedents for how political change in individual countries could trigger international economic consequences that exceeded the borders, populations, and economic significance of the countries where political change originated. The age of economic nationalism and strategic decoupling began not with government policy decisions or trade wars, but with the recognition that economic integration created vulnerabilities that could be exploited through political instability that transformed domestic governance crises into international economic weapons. The Iranian Revolution that sought political freedom achieved economic chaos that strengthened authoritarian competitors and weakened democratic partners, demonstrating that in interconnected economies, the pursuit of political goods could generate economic costs that undermine the very values that political movements sought to advance. The final irony of the Middle Eastern economic crisis is that Iranian protesters who demanded political change created economic disruptions that made political change less likely throughout the region by demonstrating the catastrophic costs of political instability in strategically important countries. The empty streets of Tehran, where protesters once demanded freedom, now serve as warnings to potential revolutionaries throughout the region about the economic consequences of challenging political stability in interconnected economies, where domestic political change could trigger international economic warfare. The revolution succeeded in destroying the old order, but failed to create conditions for the new order that revolutionaries sought to establish, leaving instead economic chaos that benefited Iran's enemies more than Iran's people.